Welcome to Inside Corporate Finance, your go-to podcast for decoding the financial world. Before we dive in, make sure to follow us, share this episode with your friends, and if you want to reach out, send us an email at insidecorporatefinance@gmail.com. If you're looking for expert insights on corporate finance, treasury, derivatives, funds, the stock market, and cutting-edge financial technology, you're in the right place. Here, we don't just talk numbers. We break down the trends, the risks, and the opportunities shaping the global economy. Whether you're a finance professional, an investor, or simply passionate about the markets, this is where you stay ahead. So grab your coffee, plug in your headphones, and let's dive into the strategies and stories that drive the financial world forward. This is Inside Corporate Finance, where money meets strategy.
Welcome to the Deep Dive. Today, we're going to be taking a deep dive into the world of risk management and financial institutions. We've got a fantastic guide for this journey, John C. Hull's book, Risk Management and Financial Institutions.
Yeah, it's a really crucial topic because, it affects everyone, from the bigwigs on Wall Street to, everyday investors like you and me.
Right. So let's jump right in. Hull starts off by talking about this core concept of risk and return for investors, the idea that if you want to make more money, well, you got to be ready to take on more risk. But is it really as straightforward as that?
Well, it's all about finding the sweet spot, the right balance. Hull really digs into this difference between the actual return you get and the expected return. Like, think of expected return as peering into a crystal ball, trying to see all the different ways your investment could play out, each with its own chances of happening. It's kind of like a weighted average, You're factoring in both the potential gains and losses.
Yeah, he even uses this example in the book. You invest, let's say, $100,000 in a stock. You might get super lucky and see like a 50% return, but there's also that chance that you could lose, 30%. So the expected return helps you weigh those possibilities, right?
Exactly. And that's super important for making smart investment decisions. Like, think of it this way. If you're looking for a safer investment, you might be okay with a smaller expected return because you're more focused on keeping your money safe rather than shooting for the moon. But if you're more comfortable with risk, you might be willing to go after those higher potential returns, even though there's a chance you could lose big.
So it's like a trade-off, right?
Yeah.
But Hall also talks about this idea of portfolio diversification, not putting all your eggs in one basket as a way to kind of manage that risk.
Right, exactly. Diversifying your portfolio means spreading your investments across different types of assets. This can help smooth out those ups and downs in the market. So, if one stock in your portfolio takes a hit, hopefully others will hold steady or even go up to kind of offset that loss.
So even if you're aiming for those high returns, diversification can help you sleep a little better at night.
Absolutely. Now, let's shift gears a bit and talk about the big players in finance, the banks. They play a huge role in managing risk, and Hull gives us some really interesting historical context here. Did you know that back in the early 1900s, most banks in the U.S. only had one single branch?
Really? Wow. That's hard to imagine now when you think about these huge banks that operate all over the world. So what changed?
Regulations. Back then, there were all these rules about interstate banking, so banks were pretty much stuck operating within their own state. It wasn't until much later, like the late 20th century, that these rules were relaxed and we started seeing those mega banks we know today. But even now, regulations are always changing, always shaping how banks deal with risk.
It's like a constant game of cat and mouse, huh? Banks try to find new ways to make money, and regulators try to keep them in check to prevent another big financial crisis. Speaking of regulations, Hall spent some time on the Volcker Rule, which is part of that Dodd-Frank Act that came after the 2008 financial crisis.
Right, the Volcker Rule. It's basically trying to stop banks from making super risky bets with their own money, something called proprietary trading. The idea is to protect people's deposits and prevent banks from taking on too much risk.
But didn't I read somewhere that this rule might actually put U.S. banks at a disadvantage compared to banks in other countries?
Yeah, that's a debate that's still going on. Some people argue that the Volcker Rule makes it harder for U.S. banks to compete on a global level, while others say it's totally necessary to prevent another financial meltdown. It's a tough balancing act, and we're still seeing how it all plays out in the long run.
It's a good reminder that even when you have the best intentions, regulations can sometimes have unexpected consequences. Now, another way banks manage risk is by raising capital, right? Hull uses the example of Google's IPO back in 2004, which used a Dutch auction system. I've always found that really interesting.
Yeah, it was a pretty innovative move at the time. In a Dutch auction, potential investors, they submit bids for the shares, And the price is set based on those bids instead of being set by the investment banks.
So it's like trying to make things fairer and give more power to individual investors.
Exactly. It's all about transparency and a more level playing field. Now, let's talk about those different types of financial risks that banks and other institutions have to deal with. It's like a whole zoo of potential threats out there.
Okay, so what kind of creatures are we talking about here?
Well, first up, we've got market risk. Basically, this is the risk of losing money because of changes in the market, like interest rates going up or down, exchange rates fluctuating, or stock prices taking a dive.
Yeah, and those things can be really unpredictable, especially in today's market. It can feel kind of like a roller coaster. So how do you even start to measure something like that?
Well, one way that's really commonly used is value at risk, VAR. It's basically a way to try and figure out the maximum amount of money you could lose over a certain period of time with a certain level of confidence. Think of it as trying to estimate that worst case scenario, just in case things really go south.
So it's not just saying, oh, we might lose some money. It's like trying to put a real number on that potential loss.
Exactly. And what's really cool is that back in the 90s, JP Morgan, they were really pioneers in using VR to completely change the way they managed risk. It helped them get a much clearer picture of how much risk they were actually taking on and make better decisions.
That's amazing how one tool can make such a big difference. Okay, so we've met the market risk beast. What other scary creatures are hiding in this financial jungle?
Well, next up is credit risk. This is the risk that someone who borrows money from you just doesn't pay it back. It's a huge concern for banks and anyone who lends money.
Yeah, I can see why that would be a big one. So how do banks try to figure out how risky a borrower is? Do they just go with their gut?
Well, luckily, there's a more systematic approach to it. They use these things called credit ratings. They're like report cards for borrowers, giving you an idea of how likely they are to default on their loans. These ratings are given out by agencies like Moody's and Standard & Poor's, and they're based on all sorts of things, like the borrower's financial history, what industry they're in, and the overall economy.
So it's a quick way to get a sense of how risky a borrower is.
Exactly. This information is super important for banks when they're deciding whether to give out a loan and, what interest rate to charge.
So we've got market risk and credit risk. What other dangers are lurking out there?
Another tricky one is liquidity risk. It's the risk that you won't be able to buy or sell something easily without really messing up its price.
So it's like if you're trying to sell a house in a town where nobody wants to live,
No.
right? Not a lot of buyers, so you have to lower the price a lot to get anyone interested.
Yeah, that's a great analogy. And for financial institutions, liquidity risk can be a major problem, especially if they need cash fast.
Yeah, I bet that's even more important when you're dealing with billions of dollars like banks do.
Absolutely. And there are two main types of liquidity risk. Liquidity trading risk, which is all about how easily you can get out of a position, and liquidity funding risk, which is about making sure you can meet those short-term obligations, basically having enough cash on hand when you really need it. Now imagine this, you've got all these systems in place, you're managing all these different kinds of risks, market risk, credit risk, liquidity risk, but then boom, somebody trips over a power cord and your whole trading system goes kaput. That's operational risk in action.
So it's like the risk of something going wrong internally, whether it's human error, systems crashing, or even like a natural disaster.
Exactly. And that can be a real nightmare for these institutions. Then there's model risk. This is the risk of using the wrong model or a model that just isn't right for pricing things, hedging, or managing risk. Models are just simplified versions of reality, and they're only as good as the assumptions that they're built on.
It's like that saying garbage in, garbage out, right? So we've met a whole bunch of different risks. What tools and techniques do financial institutions actually use to handle all of this?
That's exactly what we'll be diving into in the next part of our deep dive. We'll be looking at things like scenario analysis, stress testing, and all sorts of cool hedging strategies.
Sounds like we're just getting started. Be back soon for part 2. Welcome back to the deep dive. Last time we got introduced to some of those financial risk beasts, market risk, credit risk, liquidity risk, even operational risk. It's enough to make anyone think twice about investing.
Yeah, there are definitely some scary things out there, but the good news is financial institutions have developed all these really sophisticated tools and techniques to try and measure and manage these risks, and that's what we're going to dig into in this part of our deep dive.
All right, let's do it. So in the last part, we talked about value at risk, or VAR, as a way to estimate how much money you could potentially lose. But how do institutions actually come up with that mysterious VAR number? It can't just be a random guess, right?
You're right, it's not just throwing darts at a board. They use complex models and calculations. One of the methods Hull explains is called historical simulation.
Okay, that sounds pretty straightforward. Is it just a matter of looking at what happened in the past to predict the future?
Well, it's a little more involved than that. Historical simulation takes a ton of historical data, like let's say the daily price changes of a stock, and uses those past movements to simulate what might happen to your portfolio in the future.
So it's kind of like running a bunch of what-if scenarios, but based on what actually happened before.
Exactly. Let me give you an example from the book. Imagine you're an investor with a portfolio of stock indices, the DJIA, FTSE 100, CAC 40, and the Nikkei 225. To calculate VAR using historical simulation, you'd need to look at the historical daily changes in these indices, maybe going back 500 days.
Okay, so how much each index went up or down every day for the past 500 days? Got it. What's next?
You take those percentage changes and apply them to the current value of your portfolio. That creates 500 different potential scenarios for tomorrow. It's like creating 500 different possible futures for your investments.
Wow, 500 different possible futures. That's a lot to think about.
It is, but it gives you a range of possibilities based on real data from the past. Then, to find the one-day 99% VAR, you'd focus on the fifth worst outcome out of those 500 scenarios.
So the level of loss that would only be exceeded in 1% of those simulated scenarios. I think I'm starting to get the hang of this.
Exactly. There are some variations of historical simulation, like adjusting for volatility or using a technique called bootstrapping, but they all rely on using past data to get a sense of future risk.
But what about the assumption that history always repeats itself? Aren't there times when things happen that no one could have predicted based on past data? Like that whole meme stock craze a couple of years ago? That was wild.
That's a great point. Relying only on historical data can be risky, especially in today's world where things change so quickly. That's where the model building approach comes in. Instead of just looking back, it tries to build a statistical model to predict future outcomes.
So it's like using math to figure out the odds of different things happening.
Precisely. One common assumption in this approach is that the daily changes in things like stock prices follow what's called a normal distribution. You might remember that bell curve shape from statistics class.
Oh yeah, the one where most of the data clusters around the average and then you have fewer and fewer data points as you move further away from the center.
Exactly. And if we assume this normal distribution, we can use some pretty handy mathematical formulas to calculate VAR.
Math to the rescue. So how does that actually work in practice? Can you walk me through an example?
Sure, let's go back to a simple example of someone holding, let's say, $10 million worth of shares in Microsoft. And say we want to calculate a 10-day VAR with a 99% confidence level.
So we're trying to figure out the biggest loss we might face over those 10 days and be 99% sure it won't be any worse than that.
Exactly. First, we need to estimate the daily volatility of Microsoft's stock price, which is basically how much it tends to jump up and down each day.
And we could probably use historical data for that, right? Looking at how much the stock has moved around in the past.
Exactly. And then we can use those statistical formulas based on the normal distribution to calculate the 10-day VAR. It involves things like standard deviation and the inverse cumulative normal distribution function. But don't worry, we have spreadsheets and software to handle those complicated calculations for us.
Phew, that's a relief. I wouldn't want to be doing that by hand.
No need. But it's important to remember that not all portfolios are that simple. Things get way more complex when you have multiple assets with different correlations.
Correlations. You mean how the prices of different assets tend to move together or in opposite directions? Like how gold might go up when the stock market crashes.
Exactly. Hull explains how to calculate VAR for a portfolio with two assets using a formula that factors in the standard deviations of each asset and their correlation.
So the more closely two assets are correlated, the more they tend to move in the same direction and the bigger the impact on the overall risk of the portfolio.
Precisely. But when you have a really complex portfolio, with lots of assets, those correlation calculations can get really messy. Just imagine trying to track the correlations between hundreds or even thousands of different stocks. That would be a nightmare.
Yeah, I'm getting a headache just thinking about it.
That's where Monte Carlo simulation comes to the rescue. It's this powerful computational technique that can handle a lot of complexity.
Monte Carlo simulation. That sounds familiar. Isn't that something to do with casinos and gambling?
You're right. It was actually first developed to simulate games of chance, but it turns out to be incredibly useful for financial modeling too. In the context of VAR, Monte Carlo simulation involves randomly generating thousands or even millions of potential scenarios based on the statistical properties of your portfolio.
So it's like historical simulation on steroids, right? Instead of using actual past data, we're using a model to create all these scenarios.
Exactly. By running all these simulations, we can build up this picture of the range of possible outcomes for our portfolio and then calculate VAR from that. It's a super powerful way to really get a handle on risk, even for those super complex portfolios.
Okay, so we've got this whole toolbox for measuring market risk. Historical simulation, model building, and Monte Carlo simulation, each with its own strengths and weaknesses, I imagine.
Absolutely. Choosing the right tool depends on the specifics of the portfolio and how accurate you need to be. But it's super important to remember that we're still just talking about market risk.
Yeah.
Quantifying things like credit risk and operational risk is a whole different challenge.
So we've tamed market risk, but there are still more beasts to wrestle with in the financial jungle.
You got it. We'll get into those other risk beasts in the next part of our deep dive. We'll be looking at things like ratings, transition matrices, loss, given default calculations, and the challenges of quantifying operational risk. It's going to be a wild ride.
I'm ready for it. We'll be back soon for the final part of our risk management adventure. Welcome back to the deep dive. We've spent the last 2 parts exploring the wilds of market risk and learned how financial institutions use some pretty powerful tools to figure out how much money they could potentially lose. But as we learned in the last part, there are still more treacherous territories to navigate in this financial jungle.
You got it. We still have to tackle those beasts, credit risk and operational risk. And they require a whole different approach, a whole different set of tools to tame them.
All right, let's start with credit risk. How do institutions deal with the possibility that borrowers might not pay back their loans? Seems like a pretty big deal, especially for banks with huge loan portfolios.
It definitely is. One tool Hull highlights for assessing credit risk is this thing called the ratings transition matrix.
Ratings transition matrix. That sounds a little intimidating. What exactly is that?
Think of it like a map that shows how credit ratings can change over time. It's basically a table that shows the probability of a company moving from one credit rating to another, like over a year or some other set period of time.
So if a company starts with an A rating, this matrix would show the chances of it staying at A, getting bumps up to AA, getting downgraded to BBB, or even, in the worst case scenario, defaulting.
Exactly. And these matrices are built using historical data, by tracking how companies' credit ratings have actually changed over many years. Hull gives an example from Moody's in the book. It's like looking back at the history of credit ratings to try and understand how they might shift in the future.
So it's not just some theoretical model. It's based on what's actually happened in the real world, which gives it a bit more credibility, right?
Absolutely. And this data is really valuable for understanding credit risk. For example, the table shows that companies with an A rating have a very low probability of defaulting within a year, only about 0.06%. That's less than 1 in 1,000.
That's pretty reassuring, at least for lenders dealing with those A-rated borrowers. But how do institutions actually use this information to calculate their overall credit risk? It can't just be about looking at each borrower individually, right?
You're right. They have to consider their entire loan portfolio. Let's say a bank has a $100 million loan out to an A-rated company. They could use that 0.06% probability of default to estimate their potential loss on that loan over the next year.
So even with a very low probability of default, we're still talking about a potential loss of $60,000. That's not chump change.
Exactly. And of course, the bank would do this calculation for every single borrower in their portfolio, factoring in the size of each loan and the probability of default for each one.
So they add up all those potential losses to get an overall picture of their credit risk.
Precisely. But there's another piece of this puzzle. They also have to consider something called the loss given default, which is the percentage of the loan they expect to lose if the borrower actually does default.
So even if a loan goes bad, the bank might still be able to recover some of the money.
Exactly. They might be able to seize collateral, like a house or a car, or sell off the borrower's assets to try and recoup some of their losses. The loss given default takes that into account.
Okay, so it's a pretty complex calculation, factoring in the probability of default, the loss given default, and the size of each loan. Sounds like a lot of number crunching.
It is. But luckily, like we talked about before, there are sophisticated computer programs that can handle all these complicated calculations. And for even deeper credit risk analysis, institutions might even use techniques like Monte Carlo simulation, just like we discussed, for market risk.
So simulating thousands of different scenarios to see how their credit portfolio might hold up under different economic conditions. It's like a stress test for their loans.
Exactly. Now let's move on to that final beast, operational risk. This one's always felt a bit trickier to grasp. How do you even try to put a number on something as unpredictable as human error or system failures? It's not like you can predict when someone's going to spill their coffee on a server and bring the whole system crashing down.
It feels almost impossible to measure.
It's definitely challenging, but institutions still have to try. One approach Hull outlines is to break operational risk down into different categories, like think internal fraud, external fraud, system failures, errors in processing, and even things like natural disasters.
So it's like creating this list of all the ways things can go wrong, a catalog of potential disasters.
Exactly. And by categorizing these risks, institutions can then start to estimate how often losses occur in each category and how severe those losses tend to be.
So like how often do internal fraud events happen and how much do they usually cost? Or how likely is a natural disaster to disrupt operations and what would be the financial impact?
Exactly. They can use historical data, data from industry databases, and even scenario analysis to estimate those frequencies and severities.
There's that scenario analysis tool again. It seems to be a pretty versatile tool for risk assessment.
It really is.
Yeah.
Now, for a more advanced approach, institutions also consider things like their internal controls, their risk management practices, and their overall company culture.
So it's not just about crunching numbers, it's also about assessing how well they're managing operational risk from a more holistic perspective.
Exactly. And they can combine all of this information, the frequencies, severities, and qualitative assessments, to try and create a probability distribution of potential operational losses.
And from that distribution, they can calculate VAR for operational risk. Similar to how they do it for market risk and credit risk, it all comes full circle.
You got it. Now, it's important to remember that quantifying operational risk is still a developing area. It's just inherently trickier to measure than market risk or credit risk, which have more readily available data. It's easier to track stock prices and credit ratings than to predict when someone's going to trip over a power cord, right?
That makes sense. It's just a lot more unpredictable.
But even with those challenges, it's super important for financial institutions to at least try to quantify operational risk. Ignoring it is like walking through a minefield blindfolded.
That's definitely not a good idea. So we've covered a lot of ground in this deep dive. We've explored those big types of risks, market risk, credit risk, and operational risk. We've delved into some of the tools and techniques that are used to try and measure them and manage them.
We've seen how financial institutions use historical data, statistical models, scenario analysis, and even Monte Carlo simulation to grapple with these complex challenges.
And we've learned that it's not just about having the right tools, but also about fostering a strong risk culture, being aware of potential biases, and constantly adapting to a changing financial landscape.
Absolutely. And this stuff isn't just for Wall Street bankers. Understanding these concepts can help anyone make better, more informed decisions about their own finances, whether it's investing in the stock market, managing your credit card debt, or just planning for your financial future. Knowing about risk can make a big difference.
That's a really great point. It's about empowering ourselves to navigate the financial world with more confidence and awareness.
Exactly. And the more we understand about the risks we face, the better equipped we are to make smart decisions and reach our financial goals.
That's a great way to wrap things up. Thanks for joining us on this deep dive into the world of risk management and financial institutions.
My pleasure. Until next time.